Hello and welcome. Hope you're all well and healthy, and thank you for joining us today for this webinar on Fiore Gold. My name is Jacob Willoughby, and I'm a Vice President of Research and Analyst at Red Cloud Securities Incorporated. Joining me remotely today is Tim Moorman, CEO and Director of Fiore Gold. We'll begin today's webinar with a presentation on the company by Tim, followed by a question and answer period. As a reminder, you can type in your questions at any time, and we'll try to get through as many as we can. But before we begin, I'd like to note that there may be some forward-looking statements made in this webinar, and I would direct listeners to the cautionary notes on page 2 of Fiore's corporate presentation located on their website. For Red Cloud Securities Incorporated, I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. Also, we note that this webinar does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investment. Company-specific disclosures for Red Cloud are the following. In the last 12 months preceding the date of issuance of the research report or recommendation, Red Cloud Securities Incorporated has performed investment banking services and has been retained under a service or advisory agreement by the issuer. Also in the last 12 months, a partner, director, or officer of Red Cloud Securities Incorporated or the analyst involved in the preparation of the research report has received compensation for investment banking services from the issuer. And now I'm very happy to introduce to you Tim Moorman, CEO and Director of Fiore Gold, who will tell us more about the company.
Thanks, Jacob, and thanks everyone for coming out. I'm going to run through our presentation, and then I'm happy to take any questions at the end of it. I'll just skip through that. You can read it at your leisure, and and I'll apologize for the graphic quality in this. I threw this slide together this morning after we put out our Q3 financials after market close last night. Fiore is a Nevada-based producer with, we believe, an executable plan to get from our current just under 50,000 ounce a year production to 150,000 gold ounce production per year. And we're going to do that through three things. The Pan mine, which is our currently operating mine in Nevada, that's the cash engine that drives the growth of the company. Right next door, 8 miles away, is our Gold Rock project. It's federally permitted, and that mine, once it's in production, will take us to just over 100,000 ounces a year. We're currently looking to put that into production in 2023. Right now, we're in the starting phases of a feasibility study for that, having just completed PEA. We have 6 drill rigs turning on that, so lots of work going there to advance that towards production. And then finally, through some strategic M&A, leveraging our really strong operating team in Nevada and looking at acquiring similar open pit heap leach, particularly assets, ideally in the United States, and push us towards and indeed over that 150,000 ounce a year mark. And then one of the interesting things about the company is we have not just the 2 assets in Nevada, but a third asset called Golden Eagle in Washington State that has a 2 million ounce M&I resource. It's a current resource. We just published a resource update on that earlier this year that we think would make an excellent core for a spinout and generate further upside for our shareholders. And I'll talk a little bit about all of these assets as we go along. I'll just briefly touch on the COVID-19 situation. We've been very fortunate that our operation has really seen very minimal impact. We've obviously closed our offices in Toronto and Denver. And at the mine, we're taking a lot of extra precautions, wearing masks, keeping people distant, lots of extra cleaning, and just kind of general good sense, common sense rules that have been developed in cooperation with all of the other mining companies in Nevada. And that's one thing that's been very encouraging, is that all the companies are willing to work together and share best practices and ideas to keep our people safe. We have not seen any positive tests among our employees, and really, touch wood, that's worked very well. We're seeing no disruptions likewise with our suppliers or with our refiners. So we've been able to keep producing. And in fact, we've just put together 2 back-to-back record gold production quarters. Just a quick look at the map view. We're obviously in the western US, Pan and Gold Rock in Nevada. and Golden Eagle in Washington State. And just a little interesting bit of trivia. If you're looking as an investor to invest in a 100% domestic U.S. gold producer, that is a gold producer where all of its production comes from within the continental United States or the United States at all, we are the largest at just under 50,000 ounces a year and 160 million Canadian market cap. We are the largest fully domestic U.S. gold producer. That sounds interesting, but what we think is a really appealing idea is that as we grow to 150 to 250,000 ounce production profile, that's going to become a very, very appealing prospect for U.S. investors in particular, because they don't have to, sort of compensate for political risk factors that you might get in other jurisdictions globally. So I'll talk firstly about our Pan mine. Pan is the producing asset. It's a very typical Nevada open pit heap leach operation, oxide gold. There it is from the air. You can see there's two pits, the south pit in the south, the north pit in the north, very imaginatively named. They are joined by a fault that runs through them called the Branham Fault. The Branham Fault is the main control on mineralization there. And that fault continues on for several kilometers to the north and the south, as I'll show you on a later slide. We mine from both those open pits. We bring the ore here to a crushing circuit on the corner of the leach pad. We crush the ore, place it on the leach pad, leach it. The leach solution flows into these two ponds here, into this pond, the Barren Pond, or the Preg Pond rather, through the ADR plant. We produce gold doré, which we sell to the refiner. It's almost exclusively a gold mine. There's almost no silver in the ore body. The other thing that's really interesting about Pan is that it's an incredibly safe mine, and we pride ourselves on the safety record. Since we've purchased the mine out of bankruptcy back in 2016, we have never had a single lost time injury, and we have been the safest mine in Nevada in our size category every year we've operated the mine. And that's a pretty rare achievement in the mining industry. We're very proud of it, and we think it's a very good leading indicator for the overall effectiveness and profitability of the operations. If you're focused on safety, you're focused on all aspects of the operation, and that really shows. The history of Pan under Fiore's ownership has been one of increasing gold production every year. You can see from 2018, fiscal 2018, which was our first year in production, right up to the current year. Right now, we're guiding somewhere between an 8 and 16% increase in gold production over last year. That's primarily due to the addition of a crushing circuit, which we put in July of last year. That increasing trend in gold production will probably start to flatten out as the mine hits steady state and hits that kind of mature ongoing operation state. And we'll see gold production sitting in that 45 to 50,000 ounce a year range. Costs, we're very obviously conscious of costs. And one of the things that drives our cost profile is our stripping ratio. In 2019, our all-in sustaining costs at a mine level were just under $1,000. At a corporate level, just over $1,000. And that was at a 1.6 to 1 stripping ratio, which means we move 1.6 tons of ore for every ton, tons of waste for every ton of ore. In 2020, fiscal 2020, we guided that our costs would be a bit higher as we went through a higher stripping phase in the mine plan. That higher stripping phase is now complete. We're actually down below the life of mine stripping ratio. And of course, our costs will come down, as you'll see on the next slide. So here's a slide comparing the last two quarters. Gold produced, you see we had just over 12,000 ounces in both quarters, which each of them were a record gold quarter production. Operating cash flow metrics, this is where I have to throw on my glasses. $3.9 million in operating cash flow in Q2, $10.5 million. These are US dollars operating cash flow in Q3. Really a record quarter across all parameters. Adjusted net earnings, 2.9 million in Q2, 5.7 million in Q3. And really, I think that, by pushing down costs, by seeing higher gold production, and by record gold prices, really on almost any per share metric, we are, I think, extremely undervalued. We definitely stand out from the pack. If you plot us up on almost any metric relative to our peers, smaller producers, smaller developers, particularly those single asset ones. And if you take, for example, adjusted earning per share, 6 cents per share, or cash flow per share of 11 cents, and you annualize that, you're looking at cash flow in the range of about 40 cents a year on an annualized basis. And, typically firms will trade in at a minimum of 10 times, cash flow per share valuation. 10 times cash flow per share valuation on an annualized basis would put us up in a $400 million Canadian market cap range. We're currently sitting at about $150 million. So again, lots of room to catch up. And I'll show a few more of these kind of comparative slides in a moment. Just wrapping up on Pan though, at Pan, with the operation running smoothly and things progressing nicely there, our focus has really been on extending the mine life, on exploration, on drilling, building up the resource base, building up the reserve base, and ensuring that the mine is producing gold and generating profits for many years to come. And you can see here on an aerial view of the project, here's the north pit here in the north, the south pit in the south. The Branham Fault runs north to south through those two deposits. All of those red zones that you see on that map are exploration targets that were defined by the previous owners based on geochemistry, mapping, alteration, structure, all of the things that control the mineralization at Pan, and we see these elsewhere. But the previous owners never had a chance to drill any of these because they were busy building Pan and then going bankrupt. We have since gone out and drilled the first of these targets called the Mustang target, came up with some very encouraging long, shallow intercepts of ore grade oxide mineralization. We'll be following up on that in our next drilling program and hoping to turn that or bring that into resource and reserve base as well to bring that into the mine plan. But right now, we've just finished up about a 70,000 foot drilling program in and around, mainly around the North Pit, testing a lot of the targets we had defined there previously. That is now in with the hands of the consultants. They are producing a new reserve and resource update, and we'll be producing a new life of mine update. And we expect that out any day now, probably sometime towards the middle of September. But typically, we'll spend $1.5 million to $2 million a year on drilling to keep that mine life ahead of production, make sure that we're replacing the ore that we're producing, and keep extending that mine life. We may spend a bit more on it this year, given the good cash flow. And really, the idea would be to get a slightly longer mine life out in front of us, just to demonstrate to the market that this mine has a reasonably long life ahead of it. So with Pan operating really well, our attention now is focused on Gold Rock. And Gold Rock, as I say, is about 8 miles away as the crow flies from the Pan mine. The Pan mine would sit in that low range of hills you see in the background there. Those are the Pancake Mountains, hence the name of the Pan mine. Gold Rock had a very small operation there in the late 1980s. There's a small open pit, and the main thing that pit does is it shows us the ore body very nicely. So you can see in the wall of the pit that's facing us, you can see a kind of pinkish reddish zone bracketed to the right and to the left by those darker black rocks. That pinkish reddish zone is the ore body, and that ore body goes through the pit, and that mineralization trends for about 16 kilometers right through from one end of that property to the other. So here's an overview of the two properties together, and you can see Highway 50 in the north. That's the main east-west highway running through this part of Nevada. You can see the green outline. That's our concession boundary. We have about 200 square kilometers under claim. That's one of the largest packages, land packages controlled by a junior in Nevada. The red zones are the defined reserves and resources at Pan and at Gold Rock. And all those yellow zones are the targets, both at Pan and at Gold Rock. And you can see there's fairly extensive targets available there for us to keep exploring there, particularly at Gold Rock. And you can see that trend that runs kind of north-northeast to south-southwest through the Gold Rock deposit. And that is a structure known as the easy fault and easy anticline. And that carries on right through the project. And we think there's a lot of exploration potential there. And as well, one of our neighbors, Kinross Gold, they operate the Bald Mountain mine just to the north of the highway. Bald Mountain currently hosts about 2 million ounces of reserves. And Kinross felt that the geology at Gold Rock was so similar in comparison to the geology, or very, very similar to the geology at Bald Mountain, that they came in as a strategic investor when we picked up these assets back in 2017, and they continue to own just under 6% of Fiore stock. They're very, very supportive and very helpful shareholders. Currently, Gold Rock hosts an indicated resource of just over 400,000 ounces at about 30% higher grade than Pan. It holds an inferred resource of about 84,000 ounces, again, at significantly higher grade than Pan. But we think there's a lot of exploration potential there and a lot of room to grow that resource, and which is why we currently have 6 drill rigs turning at Gold Rock. They'll be turning there doing a almost 200,000 foot program over the next several months. And that's a mix of core and RC rigs, mainly targeting resource growth, but also targeting metallurgical testing holes, geotechnical testing holes, some condemnation holes as well. And the goal is to grow that M&I resource from about 400,000 ounces up to about 750,000 ounces ahead of the feasibility study that's currently underway at Gold Rock. We did put out a PEA on Gold Rock a few months ago that looked at the economics of an open pit mine there, really looking at it not as a standalone mine, but as a satellite operation to our existing Pan mine. So you'd have the same management team, the same administrative team, the same mining team, all operating both mines together, using a lot of the existing infrastructure. So the Pan access road comes in from the north here into the Pan mine. We've extended that road down to Gold Rock. The power line for Pan comes in from the west. It's that yellow line you see there. We'll tie into that power line and bring it the 3 or 4 miles over to Gold Rock to bring power there. Again, saving the expense of building all these things from scratch. We'll probably use the assay lab at Pan. And as we go into the feasibility, we'll be looking to leverage those synergies even more, hopefully using the complete ADR plant where we would treat the loaded carbon and produce gold doré for both sites. Some of the metrics from the PEA, looking at about 56,000 ounces a year of gold production combined with the 45 to 50 from Pan, that would take us up over 100,000 ounces a year in Nevada through organic growth. Mine life of 6.5 years. Again, lots of drilling going on to extend that mine life and hopefully extend that mine throughput and gold production profile as well. Current pre-production capex of about $65 million, about 15 million, or about 25% of that capex is pre-capitalized stripping, removing some of the waste rock to expose the ore body. We think that there's plenty of room there to reduce that stripping ratio, reduce the amount of waste material we have to move, because there weren't any geotechnical studies at all conducted at the Gold Rock project before we came along. So we had to make relatively conservative assumptions about how steep the pit slopes were going to be. We're going to be doing quite a bit of geotechnical drilling at the site. We've engaged a geotechnical consultant, and hopefully as we steepen up those pits, we know that we'll see that stripping ratio come down quite significantly, which will reduce both CapEx and OpEx costs. Again, other exploration work, mine optimization, geotechnical studies, all kinds of things going on as we aim to have a feasibility study out towards the end of next summer. So about this time next year. And I'll just talk quickly about Golden Eagle. Golden Eagle is that third project up in Washington State. And just one thing to note that I should have mentioned at the beginning is, all 3 of these assets, the Pan mine fully built and permitted and producing, the Gold Rock project now fully permitted and in feasibility stage, and this Golden Eagle project with a 2 million ounce M&I resource. We bought all 3 of these assets back in 2016 for $5 million. I think it was the steal of a lifetime. Anyway, Golden Eagle, lots of drilling conducted there over the years. There's a very solid resource there, 2 million ounces of M&I at 1.38 grams per ton. It's just outside the town of Republic, Washington, just south of the Canadian border. It's an old historical mining district. You've got the 2 Kinross mines were the latest mines to go into care and maintenance there. They're Buckhorn and Kettle River Mill. But this area produced gold from about the 1800s right up until 2017. The biggest issue we have in the area, though, is that if you look at the ore body, it's entirely contained within Fiore's concessions, but we would have to push the edges of the open pit, that green envelope you see there around the ore body in that upper right graphic. We'd have to push that into ground next door to us, controlled by Hecla Mining. And so we had originally talked to Hecla about getting a layback agreement to allow us to mine waste from their deposit, or from their claims rather. During those discussions, Hecla mentioned that they'd been doing a lot of drilling on their side of the concession boundary, and that they felt they had drilled off somewhere between 1.5 million to 2 million ounces on their side of the ground. And so, immediately our thought was, well, look, why don't we put these things together? It's a lot more interesting to have a 3.5 to 4 million ounce deposit than it is to have 2.5 million to 2 million ounce deposits. And I think they like the idea. We've had a number of ongoing discussions with them over the last year or so. They don't move particularly quickly. But lately, we've also brought Kinross into the conversation because they have a fully permitted and constructed mill about 8 miles away by road at their Kettle River mine. And so those discussions are ongoing. They're going slowly, but we think these 3 projects or 3 assets merged together would make an excellent core for a spinco. And I'll just show you some valuation ideas for that. I will say, though, that regardless of how long these discussions take, it costs us about $10,000 a year to hold these assets. So there's no great impetus for us to do a deal in a hurry. But, this gives you an idea of what kind of valuation we think we could unlock with this. And remember, this is our 3rd project, kind of overlooked and forgotten. and not really given a lot of focus by management because we're focused more on Nevada right now. But right now, as it stands, Golden Eagle is just a little bit smaller than Integra Resources' Delamar project in Idaho, another northwestern U.S. project. And, right now Integra, based on that one project alone, has a market cap somewhere in the $250 million to $300 million range. So almost double that of Fiore, with this project almost as big as theirs as our third kind of overlooked project. If you were to combine that project with the adjacent Hecla ground, that would leapfrog that up into being about the second largest undeveloped gold project in the United States outside the hands of a major. And, that's comparable in size to, say, Midas Gold's project, Stibnite, again, another Idaho project that's currently going through permitting process. And, Midas right now has a market cap somewhere in the $350 million range on a fully diluted basis. So again, lots of value to unlock here, we think, by spinning this out and getting its own management team and, allowing investors to focus on it apart from Fiore Gold. But again, no great rush, 10 grand a year to hold it. We can afford to be patient. Capital structure is very similar, just under 100 million shares outstanding. There are 29 million options and warrants. Right now, there are 23 million warrants of that 29 million, priced at between $1.70 and $1.77 Canadian. Those all expire in about a month from now on September 26th. They may come in or they may expire out of the money, but either way, they'll be gone by September 26th. The remainder of those are options and RSUs priced. I think about half of them are in the money right now. Cash, US 17 million in cash as of the last quarter, working capital of about 34 million US, market cap sitting around 140 million Canadian or 100 million US. Analyst coverage, we have 5 different analysts covering us, including Jacob Willoughby at Red Cloud. And just looking at some of the metrics, comparing Fiore to our peers, and many of these peers, these are their single asset producers or developers, many of them operating in very, very sketchy jurisdictions, Latin America, Papua New Guinea, and still, we're lagging behind on almost every metric: price to NAV, price to cash flow, EV to EBITDA, EV to 2020 production ounces. I think the stock still has a long way to go. We've had a pretty good run up over the last few months, but I think as people start to realize just how undervalued this is, particularly given the strong cash flow from the company, I think there's a lot of share price appreciation still to come. And I'll just wrap up with this. We've focused very much on operations, on execution, on, we think, under-promising and over-delivering. And we said we were going to get this bankrupt mine up and running and generating cash flow, and we've done that. We said we were going to get the crusher installed. We did that out of cash flow. And keep in mind that Fiore has no debt and hasn't issued equity since September of 2017. So we tend to treat our shareholders with a great deal more respect than a lot of companies do. We said we'd get Gold Rock permitted, and we've done that. We said we'd get the PEA out and the resource update out on Gold Rock. We've done that. We're now straight into a feasibility study on Gold Rock with the goal of getting that one into production by 2023. We put out a new resource update on Golden Eagle, and we're working to merge that with some other assets and make that the core of a spinout. Pan resource expansion drilling, that's now completed. And then finally, upcoming catalysts, lots of catalysts still to come. Gold Rock feasibility work. We've got 6 drill rigs turning at Gold Rock. We'll have them drilling for several more months and lots of drill results coming out of there, and then more metallurgical work and other testing work coming out of the feasibility process. We'll have a reserve and resource update and a new life of mine update on Pan in the next few weeks. We'll have lots more exploration both at Pan and Gold Rock. And then finally, looking for some developments on acquisitions. We think there are a lot of small single asset companies out there that don't make a lot of sense. As standalone companies would make a lot more sense folded in under the really, really excellent operating team at Pan and at Fiore, and create a new US-focused multi-asset gold producer. And I'll just leave you with a very nice picture of the Pan mine looking out over the snow-capped mountains of Nevada. And thanks, and I'm happy to take any questions.
Great, thank you, Tim. I did notice you worked very diligently to get through that quickly. maybe a little bit too quickly, but I really like that presentation and appreciate the valuation stuff that you've included there, because when the stock isn't appreciated as much as Fiore has, sometimes people start to naturally assume that that the upside's gone and the stock's getting expensive. But nothing could be further from the truth with Fiore. On to questions. All right. Here is asking about drilling is being done at Pan right now.
So there aren't any drills turning at Pan right now because we've just finished up the drill program and we're doing the resource and reserve update. But as soon as that reserve and resource update is complete in the next few weeks, we're actually going to bring the drills over and start doing some metallurgical test work out there, some metallurgical drilling, just to, as a kind of cautionary measure. We've been expanding out with our resource and reserve updates in the new area, and we just want to make sure that the met looks the same as the current rocks, and no reason to believe it doesn't. But again, you want to confirm that, and then we'll start probably in October on the new exploration program out there. We typically budget, as I said, about $1.5 million to $2 million a year, so that's probably in the sort of 50,000 feet or it's at about 20,000 meters of drilling over the year. We'll be targeting a lot of those more distal targets. We'll be trying to prove up that Mustang target that we've had some good initial hits on. Yeah, that's kind of the plan for the year. And that will kind of be typical for every year. So $1.5 million to $2 million on drilling to keep building the resource space.
Right. Now, you did, I think, in the presentation mention about a Pan and Gold Rock regional exploration update still to come in the second half. So I imagine that's maybe a September, October kind of thing.
Yeah, and what we really want to do is get sort of people in boots back out on the ground. So much of the exploration right now has been focused on drilling because there's just so much to drill. But we don't want to lose sight of that kind of more basic exploration. I think there's a lot of potential upside in this area, particularly over at Gold Rock, but also at Pan. I mean, they're big property packages. We're not constrained by geology. There's nothing cut off. There's no, we don't run into the neighboring claim package. It's a lot of open ground there and lots of exploration work to do there. And I think people sometimes forget that, Pan is as much an exploration story as it is a production story.
That's a great point that I think is lost on a lot of people who don't realize just how badly things were done prior to your involvement with the story. In fact, I think some mining engineering schools could make a course on how to effectively screw up a heap leach gold project in the United States with the former operator. So there wasn't nearly enough exploration drilling done before you acquired the assets. And then when you did, you were focused on getting the cash flow and not diluting shareholders and things like that, and which you've done an excellent job of. There's a fairly technical question here, which don't always get, but very, very happy to see. Asking if you're using agglomeration to manage the clay content at Pan.
Yeah, yes and no. We blend the ore at Pan, and so the primary way that we deal with the clay content, and for those of you who aren't familiar with the history of Pan, the south pit is more clay dominant, the north pit is more hard rock silica dominant, and one of the problems that the previous owner ran into is they tried to just mine from the south pit because it has a better recovery profile. And the problem is, though, you can't mine that rock alone. It's too clay rich and it clogs up the leach pad, which is exactly what happened. Which we then had to go back in and fix. So the key thing we've done to manage that permeability issue and deal with the clay is to blend it with the coarse rock from the north pit. And, we ran the mine for the first 2 years as what's called a run of mine operation. So there was no crushing at all. We just blended the rock with bulldozers on the leach pad. And that worked fine. We had no issues at all with permeability. Now that we're crushing the material, it actually gives us the option to add, rather than using lime to control the pH, because you have to keep the pH very high on a leach pad when you're using cyanide. Otherwise, you tend to kill everyone, which is bad. And anyway, we've now switched over to using cement to control the pH. And the cement has a kind of secondary attribute, is that it helps bind the clay particles to the coarser rock particles as it goes through the crusher. And so yeah, it's a long way of saying kind of agglomeration, but not really deliberately agglomerating the ore. It's more binding it up a bit.
So everyone understands that's wet cement, not
yeah.
actual hard or anything.
Yeah, that's right. Cement powder is going on to the along with water.
Okay, move along here. Let's see. All right, there's a question. Now you kind of asked for this because you went and poked the investors here and talked about a spin out. So of course there's a question about, if Gold Eagle gets spun out, will current shareholders get shares of the Gold Eagle Newco, or what percentage of shares will be Newco, or how much would Fiore own, et cetera, et cetera.
Yeah.
I understand that's probably way ahead in the distance that you may not have actually worked out yet.
Yeah, I think that's probably the best answer. Is haven't decided that yet. We, I think in the initial go round, the idea would be that ourselves, Hecla and Kinross, would each contribute our assets in the area. We would own the new co or the spin co in pro rata to the value of the assets, and of course that's where all the argument is going to come from, whose assets are worth more. And then really it would be up to the three companies on what to do with their fractional ownership of this new company, whether you distribute them to shareholders or whether you hang on to them or sell them or and distribute the cash. It's really a kind of a unanswered question right now. We're focused on doing the transaction first, and then we'll sort of it'll be a good problem to have.
Right. And now this might not be disseminated in the public, but is the grade profile on the side of Hecla's boundary similar or a lot different than what you have at Gold Rock?
Yeah, honestly, don't know. We've only had very tentative discussions, with Gold Rock or with Hecla about Golden Eagle. They've talked in very general terms about what's there, but we haven't done the deep dive into each other's technical data yet.
Okay, so it's still pretty early.
Yeah, it's been a slow process. Sometimes the larger companies can be very slow to act. And it's not a core asset for them, but I mean, it's such a great opportunity. We're not getting any value for Golden Eagle. Hecla, I don't even think Hecla shareholders know they have ground in Washington State. And
right.
Certainly from a Kinross's point of view, they've got a mine there that they're going to have to decide what to do with in terms of closure. It's a closed mine right now. It's costing them money. And if they don't do something with it soon, they're going to have to pay the closure costs. So it's almost a liability for them. So, if you could put those three assets into a spinout, and this would be a spinout backed by three producing gold companies. I don't see how isn't a win-win-win for all three companies and for shareholders.
Yeah, so Kinross might be a little bit more motivated to move in a faster manner than Hecla based on that.
You'd like to think so.
Yeah, but then again, they're run by Paul Rollinson, and he's just a geologist.
And he's a geologist. That's what as am I. So
me three. So another question here. I love this question. With possibly $44 million in cash flow next year, can you develop Gold Rock without doing any equity financing?
Yeah, that's a good question. Obviously, if gold prices stay strong, then yeah, that might be a possibility. I don't want to try and predict gold prices, but yeah, look, I think obviously, regardless, we're going to be in a pretty strong cash position. And if not all of it, we'd certainly be able to fund a significant portion of it through our own resources. Having said that, I don't think there's a problem with taking on, a reasonable amount of debt if it's for a very good, goal or use, such as building a new asset that's going to contribute cash flow to the company. So yeah, I suspect there will be, in the end, some mixture of debt and our own resources used to build that, but it's not going to be a crippling level of debt by any means.
And presumably, your stock would be multiple than of where it is now.
You would like to think so.
Okay. So just to remind everybody, the project at Gold Rock is fully permitted, basically?
Yeah, so it's fully permitted on the federal level, which is the long, painful process in the U.S. that a lot of companies are going through. If people follow Midas Gold or Hud Bay, their project in Arizona, or even projects in Nevada right now, it's called the NEPA process. And it, like as an example, Gold Rock took almost 10 years to go from one end of that permitting process to the other. That was somewhat exceptionally long, but not really unusual. And of course, probably the most dramatic one that's in the middle of that right now is the Pebble project up in Alaska. And that process is not free of politics. But yeah, we've got that behind us. We got our EIS, which is the highest level of study. We got that approved back in 2018. There are still permits at the state level to get. Those are typically obtained as you get closer to a more detailed design of, so exactly what equipment, exactly what, down to the kind of model numbers, because you have to do things like air modeling and things like that. But they tend to be more routine programmatic sorts of permits. And the regulators in Nevada are very familiar with this kind of thing. We deal with them every day. And, one of the big advantages we have is that, PAN, I think, has a really, really strong environmental compliance record. We are not by any means the problem children for the regulators in Nevada. In fact, on some of our things, the regulators have been able to cut back the frequency of our inspections and focus on other, operations where there are more problems, just because they're not finding anything when they come out there. We're in compliance. They're happy with how we operate. We're very transparent with them, and I'm hoping that will lead to a less painful or easier time in getting the state permits. But again, we've allowed for that, in the timeline process that we've laid out.
Great. Okay. Next question here. You talked about acquisitions, so people are going to ask you. So generally, what kind of acquisition targets are you seeing, and what would you prefer?
Yeah, the way we look at it is that the further away it is, or the more different it looks to PAN, the better it's got to look. So, an open pit heap leach operation in Nevada, we'd jump on that in a second, provided that the economics made sense. And we've looked at a few, and a few of them, look, other companies have acquired them, and I don't think. I think we made the right decision in many of those cases to pass on them. But there are a few other assets that we're looking at now that we think would fit very nicely into it. We'd certainly look at an underground operation, but again, it's not our forte. It would have to be pretty good if it was, because obviously we'd have to add to the team and add to our skill set to operate an underground mine. And we'd look outside of the U.S. as well, but we wouldn't look far outside the U.S. I don't think. We'd look at Canada. We might look at northern Mexico if it made sense. I've worked in Mexico before, so but again, the further away it is from Nevada, the better it's got to be. So,
right. Okay. A question about there's been some people who mentioned that they've had trouble with the audio or the video on this, and they're asking about replay of this. All our webinars are edited, fixed up for any flaws and mistakes, and then they're always available for replay on our website, and we send out a link for those. So just that takes care of that one for people who may have had some issues there, because there have been some people mentioning that. Let's see. There's a lot today, but a lot of them are very similar. Okay, so asking about, or actually, there's somebody stating that there are some sulfides at Gold Rock, which must be deeper down. Is there much potential to that, or is that something you're not really looking at this point?
Yeah, no, we haven't. We've seen the odd bit of fine sulfide in some of the ore, but it's not related to the gold mineralization. It's a sort of seems to be a later, sulfide doesn't really seem to, impact the recoverability of the gold at all. It's something obviously you have to focus on with pH control a bit more, but really, it's oxide as deep as we've drilled to get into true sulfide mineralization. The way you get at some of the deeper levels up at some of the Carlin ore bodies, the Nevada Gold Mine operations there. It's certainly a possibility. There's no reason to believe that you wouldn't find some of those higher grade sulfide zones at depth, and we'd certainly like to drill some deeper holes. I know one of our geologists came to us from Barrick. So she's very familiar with these deeper sulfide ore bodies, and would be quite keen to stick some deeper drill holes in it. And it's really just a matter of finding the time to do that.
Okay. All right. That exhausts most of the online questions. Let me see here. Oh, you talked about adjusted earnings, and so maybe I'll just get you to quickly talk about what you're adjusting for when you say adjusting.
That's a good question, and I'm actually going to have to tell you that I wish our CFO was on, because he could explain that more deeply. I'm a geologist, and And I wouldn't even want to touch that question because it delves into accounting that's far over my head at the moment. My CFO is probably listening and laughing at me right now.
Yeah, come to think of it, I do remember going through that with Barry before, and I forget exactly what it is, but it's egregious or anything.
If anybody would like to explore that question in more detail, feel free to reach out to Barry O'Shea. And oh, hang on, this is funny. My CFO just text messaged me and he says the only adjustment on the earnings is the share purchase warrants on a mark-to-market basis, and as we say, those will disappear at the end of next month. So there you go. There's your answer.
Okay.
But if you want to have a more fulsome discussion on any of those issues with our CFO, he's always happy to talk to investors.
Great. You did too good a job, and you answered all the questions I was going to ask when we sort of ran out of questions. So maybe we'll call it here. And congratulations on back-to-back record quarters and tremendous success. And thank you for setting this up in such a timely manner right after your quarter. We appreciate it. And thank you everyone for participating and for all your questions. And thank you, Barry, for chiming in as well. I'll just mention that our next webinar is actually tomorrow also at 2 p.m. That is with Tarachi Gold, and I will be hosting it, and I'll have the president and CEO, Lauren Warner, which is a interesting company. Probably a lot of people want to hear about it because I think that stock started the year at 8 cents and now it's about 70. And they're just getting started on drilling. So that should be one that will be interesting. So thanks again to everybody and to you, Tim. And we'll sign off there and hope everyone stays healthy and safe.
Thanks, everyone.